This is a rupee, 50 rupees to be exact, a single bill with Gandhi's face on it. In 1990, this would buy you a meal for a family of 4. Today, it barely covers a cup of chai at a Mumbai street stall. The rupee has lost 83% of its purchasing power against the dollar in 35 years, not because of war, not because of famine, because the government printed more of them than the economy could absorb. But here's what's strange. For the past 5 years, a generation of young Indians found a way out, an escape hatch from a currency that loses value every year. They bought Bitcoin, not because they were speculators or tech enthusiasts or criminals, because they understood something their parents' generation never had to face. In a country where inflation runs 6% and bank deposits pay 4%, holding rupees is a guaranteed path to poverty. Last Tuesday, at 9 p.m. Indian Standard Time, the Reserve Bank of India published a 4-paragraph notice that ended that escape. Effective immediately, all cryptocurrency transactions are prohibited for Indian residents. Banks are forbidden from processing crypto-related transfers. Exchanges have 72 hours to cease operations. Violators face up to 10 years imprisonment. No parliamentary debate. No public comment period. No warning. Just a notice on a Tuesday night, while most of the country was watching cricket. Within 48 hours, $15 billion in capital began moving out of India through channels that the RBI cannot track, cannot stop, and cannot reverse. This is not about Bitcoin. This is about what happens when 1.4 billion people discover that their government fears financial freedom more than it fears capital flight. Here's what they're not telling you. India has tried to ban cryptocurrency before. In 2018, the RBI issued a circular prohibiting banks from servicing crypto businesses. The Supreme Court struck it down in 2020, calling it unconstitutional. In 2021, the government proposed the Cryptocurrency and Regulation of Official Digital Currency Bill, which would have banned all private cryptocurrencies. It never passed. In 2022, they imposed a 30% tax on crypto gains and a 1% TDS on all transactions, a de facto ban through taxation. Trading volumes fell 90%, but the market survived. Each time, the government discovered the same truth. You cannot ban mathematics. You can ban exchanges. You can ban bank transfers. You can imprison people for holding digital assets. But you cannot ban the ability of 2 humans with smartphones to transfer value across borders without permission. The technology doesn't care about jurisdiction. What changed in January 2026 was desperation. The rupee has fallen 12% against the dollar in the past 6 months. Foreign exchange reserves dropped from $620 billion to $531 billion as the RBI spent dollars defending the currency. The trade deficit is running $25 billion per month, and the RBI discovered something that terrified them more than any of these numbers. Educated, wealthy Indians were converting rupees to Bitcoin at a rate of $2 billion per month. Not to speculate, to escape. The official story is that cryptocurrency enables money laundering and terror financing, that banning it protects Indian citizens, that digital assets are too volatile for retail investors. The data shows something different. The data shows a central bank watching capital flee a currency they're trying to defend and choosing control over freedom. This is where the lie becomes unsustainable. To understand what $15 billion in capital flight means, you need to understand how money actually moves when a government closes the official doors. The RBI can ban Coinbase and Binance. They can freeze bank accounts linked to known exchanges. They can monitor wire transfers and flag suspicious patterns. What they cannot do is stop peer-to-peer transactions. Bitcoin exists on a network of 50,000 computers spread across every country on Earth. There is no server to shut down, no company to sanction, no CEO to arrest. When an Indian citizen wants to convert rupees to Bitcoin, they don't need an exchange. They need a phone and someone willing to trade. In the 72 hours following the ban, peer-to-peer Bitcoin trading volume in India increased 847%. Not through Binance or WazirX or any platform the government can monitor. Through local Bitcoins, through Paxful, through Telegram groups and WhatsApp networks and in-person cash trades in coffee shops across Mumbai, Delhi, and Bangalore. The premium tells the story. Before the ban, Bitcoin traded at roughly a 2% premium in India due to rupee weakness and exchange friction. By Thursday morning, the premium hit 23%. Indians were paying $98,000 for a Bitcoin trading at $79,600 globally. They were paying $18,400 extra per coin, not because they didn't understand the price, but because escaping the rupee was worth the premium. This is not speculation. This is capital preservation by people who have watched their parents' savings evaporate across 3 generations of currency devaluation. When governments do what India did on Tuesday, they're not protecting citizens, they're trapping them. The playbook is familiar because it's been used before. Venezuela banned cryptocurrency in 2017. Trading volume increased 400% within a year as hyperinflation made the bolivar worthless. Nigeria banned crypto in 2021. Peer-to-peer volume tripled as the naira collapsed. China banned crypto mining and trading in 2021. Miners relocated to Kazakhstan and Texas within 6 months, and Chinese traders simply used VPNs. Every ban has produced the same result. The activity moves underground, becomes harder to track, and accelerates as citizens lose trust in the institutions trying to stop them. The RBI published its enforcement guidance at 3:15 a.m. on Thursday, a 47-page document outlining penalties, reporting requirements, and surveillance mechanisms. Banks must report any transaction over 50,000 rupees that shows patterns consistent with cryptocurrency acquisition. Payment processors must flag purchases at known crypto-adjacent merchants. Mobile carriers must provide metadata on users accessing foreign exchange and trading platforms. This is a surveillance apparatus built to catch people trying to protect their savings. The irony is architectural. A government that cannot stop the rupee from falling 12% in 6 months believes it can monitor 1.4 billion people's WhatsApp messages. The last time India attempted capital controls of this magnitude was 2016, during demonetization. The government banned 86% of currency in circulation overnight, forcing citizens to deposit cash into banks or watch it become worthless. The stated goal was eliminating black money. The actual result was economic chaos, GDP contraction, and no measurable reduction in corruption. The crypto ban will follow the same trajectory. Except this time, the escape route doesn't require physical cash. It requires only knowledge and a smartphone. Less than 30 days remain before the full enforcement mechanism activates on February 15th. Between now and then, every Indian holding cryptocurrency faces a choice. Sell at a 23% discount to global prices, transfer to foreign wallets through increasingly surveilled channels, or hold and hope the Supreme Court strikes down another unconstitutional overreach. The smart money has already chosen. The $15 billion in capital flight isn't hypothetical. It's tracked in blockchain analytics, in suspicious transaction reports from Dubai and Singapore banks, in the sudden spike in business travel to countries with crypto-friendly regulations. Wealthy Indians are not waiting for the courts. They're moving money while the moving is still possible. While one side bans, the other side builds. This is the asymmetry that makes cryptocurrency different from every previous form of capital flight. When governments banned gold, they could confiscate it at borders. When they banned foreign currency, they could monitor bank accounts. When they imposed capital controls, they could track wire transfers. Bitcoin exists everywhere and nowhere. It's a string of numbers that can be memorized, written on paper, embedded in an image, or stored on a device the size of a fingernail. An Indian citizen can walk through customs with $10 million in Bitcoin stored in their head, 12 words memorized that reconstruct a wallet no X-ray can detect, no search can find, no border agent can confiscate. The RBI understands this. Their own internal assessment, leaked to the Economic Times last week, acknowledged that complete enforcement of cryptocurrency prohibition is technically infeasible, given the decentralized nature of blockchain networks. They're banning something they admit they cannot stop. The ban is not about prevention, it's about punishment, about making the cost of escape high enough that most people won't try. But most people, and wealthy people, are different populations. The rickshaw driver in Chennai doesn't have Bitcoin. The software engineer in Bangalore does. The street vendor in Kolkata doesn't understand blockchain. The son of an industrialist in Mumbai does. India's crypto ban is a class filter, effective at trapping the poor in a depreciating currency while the rich find ways around it. The $15 billion leaving India isn't coming from the bottom, it's coming from the top, from the families with foreign passports, from the entrepreneurs with Singapore subsidiaries, from the tech workers with Coinbase accounts they opened during overseas assignments. The people most capable of building India's future are the people most incentivized to leave. This is what a system looks like when it chooses control over prosperity. Every response available to the Indian government now accelerates the problem they're trying to solve. Enforce the ban harshly, and wealthy Indians accelerate their exit. Enforce it loosely, and the ban becomes theater that undermines institutional credibility. Allow exceptions for institutional investors, and retail citizens see a two-tier system that protects the rich. Reverse the ban, and admit the policy was a mistake, encouraging future capital flight at every rumor of restriction. The rupee's collapse is not separate from this story. It's the cause. When a currency loses 12% in 6 months, citizens seek alternatives. When the government bans the most accessible alternative, citizens seek exits. When exits require moving capital offshore, foreign exchange reserves drain faster. When reserves drain, the central bank has fewer dollars to defend the currency. When the currency falls further, more citizens seek alternatives. This is the doom loop that every emerging market central bank fears. This is why the RBI acted at 9 p.m. on a Tuesday with no warning. Not because they had a plan, because they were out of time. The $531 billion in remaining reserves sounds enormous until you realize India imports $60 billion per month. That's less than 9 months of import cover. The RBI's own guidelines call for 12 months minimum. They are defending a currency with ammunition they cannot afford to spend. Some will read the news and see a government protecting its citizens from volatile assets. We'll see prudent regulation of a speculative market. We'll trust that institutions acting in darkness have the public interest at heart. These are the same voices that said demonetization would eliminate black money, that said the rupee would stabilize at 75 to the dollar, that said Indian growth would hit 9% by 2025. The voices are always confident. The currency charts tell a different story. Others will see what the ban actually reveals. A central bank that cannot defend its currency through legitimate means, resorting to prohibition. A government that fears its citizens' choices more than it values their freedom. An economy where the most talented, most mobile, most entrepreneurial citizens are being given every incentive to leave. The informed are not waiting for February 15th. They're not debating whether the Supreme Court will intervene. They're recognizing that a government willing to ban cryptocurrency at 9 p.m. on a Tuesday is a government that will ban gold imports, restrict foreign travel, freeze bank accounts, and impose whatever controls it believes necessary to trap capital within its borders. What the informed understand is that this ban is not the end. It's the beginning. The first move in a sequence of escalating controls that emerging market governments deploy when currencies fail. Argentina did it. Venezuela did it. Turkey did it. Nigeria did it. The playbook is identical. The timeline is compressed. The ending is always the same. The controls fail, the currency collapses, and the citizens who stayed discover what their obedience cost them. This is not financial advice. This is not a recommendation to violate Indian law or evade capital controls. This is simply an observation about what happens when governments fight mathematics with legislation. About what $15 billion in capital flight reveals about confidence in a currency. About what a 23% premium on Bitcoin tells you about how badly people want to escape. The rupee's future will not be determined by RBI policy statements or government press releases. It will be determined by the daily choices of 1.4 billion people deciding whether to hold their wealth in a currency their government is debasing or seek alternatives their government is banning. Tuesday's notice was supposed to end the debate. Instead, it clarified the terms. The government has chosen control. The citizens are choosing exit. And in that choice, repeated millions of times across coffee shops and telegram groups and family conversations, the fate of the rupee is being written, not in policy documents, in transactions.